Wonderful. Please help me welcome Rick Romeo.
Thank you, Vicki. Can everybody hear me okay?
Yes.
Good. I do know how to project, but I don't usually use one of these. But since we're taping, I was told to do that, so I will do it. So I know some of you and not others, but I know of your organization. I support your goals, and I think it's great that you're doing the work you're doing. And education is a big piece of that. And education is a big piece of what I do too. I think it's very important. So I do a lot of these talks, and I always tell folks, take full advantage of it. This is your chance to ask any question of a lawyer, and I won't send you a bill. So I like to run these more informally. I do have an outline. We will get through everything. But I do encourage you, and I find that it works better. If you have a question as we go along, shoot your hand up. I'll answer that, and chances are it's going to be in my outline anyway, but I want to make sure that I get all of your questions answered as well. So the main topic is Medicaid. I'm going to preface that with some remarks just about paying for long-term care in general. In your packet, I've also included a few other things. I have a handout on living wills and powers of attorney. I have a particularly useful document that is called a value assessment survey. This document is very useful when you're doing an advance directive, because most of you, I'm sure in this room, have done advance directives, but it's not enough just to do the directive. You have to make sure that the agent that you've named in a power of attorney or in a most form or some other way knows really what you want and knows that in great detail. So that's what this does, and you're welcome to keep these, use these, and sit down with your agent and a bottle of wine some night and go through it, because it's not easy. The first couple of pages deal with what's important to you. So it truly is a survey of your values. And you can rate things on a scale. And that's useful, but then it goes on to very specific situations, hypothetical situations. If I'm in this condition, I do or I don't want the following procedures. So then you can fill in a lot of detail there. Then you get to the end of the form, and it has a series of statements about what you agree with or don't agree with. So it's really designed to be a roadmap to your end-of-life wishes. And of course, you can continue on and write anything else you want, up to and including a short novella about all your end-of-life wishes. But if you don't do anything, in my experience, you find that you might think that your spouse or your children know what your wishes are, but they probably don't know it at the level that they need to know it. So you can relieve them of some of the burden and some of the guilt that might come with making the choices you want to be made if you're very specific about those choices. And this is just a tool to help you do that. So I thought that might be useful, particularly for this group. The other handout I have is on veterans benefits, which I don't have time to spend a lot of time on today, but it's for those of you who have served, and since it's close to Veterans Day, there are some valuable long-term care benefits under the VA system. And I'll just touch on that in my overview before I jump into Medicaid. So I'm talking about Medicaid today for paying for long-term care. So backing up just one step to that general topic, paying for long-term care, what are the ways you can do that? So now we're talking about long-term care delivered either in your home or in an assisted living facility or in a nursing home. So by long-term care, we're talking about not acute care where you fall and break your hip and you're going to the hospital. Your Medicare, your insurance is going to cover that. But if you have a chronic illness or just old age and you need a little more help at home to stay independent, maybe you need help bathing, with mobility, preparing meals, overseeing medications, driving, some of those things, then you're getting into that realm of long-term care. And it can get quite expensive at the most acute level, nursing home care can be up to $10,000 a month in this county at Fraser Meadows, which is probably the premier place in Boulder County, but it starts at $7,000, moves up from there. Home care, of course, is cheaper, maybe $20 to $23 an hour for home care. And assisted living will run you around $4,000 to $5,000 in Boulder County. So how do you pay for that? You can pay out of your own assets and income, but for most of us, you know, in the sort of middle class range, you may have some savings and some retirement income, but not enough to really sustain a high level of long-term care over a long period of time. So certainly your own assets and income are going to be part of the picture, but there are some other ways to pay as well. Long-term care insurance is one that comes to mind. How many people have a policy of long-term care insurance? Yeah, I see the smattering of hands, and that's pretty typical. I think nationwide it's less than 10%. I do advocate it for my clients. I don't sell it, but there are people who do, who are very good, who understand the products. I think it's a good idea for several reasons. I wonder whether the Medicaid system, which I'll talk about, the sort of safety net for long-term care, is going to be there in its current form when we all need it. And if it's not, then, you know, what else do you have? The advantage of insurance is that you're using, it's like any insurance, you're using other people's dollars instead of your own dollars to pay for the care. And what I find is that people are more willing to use those dollars than their own dollars, and therefore they will get care sooner, which actually helps you stay at home. If you have a policy of long-term care insurance and you're finding that you need some help at home, you're probably going to call up that company. You've been paying your premiums for 10 years. Now you're going to trigger the policy and get them to send some people over to help you. So I like it from that standpoint as well. And that's probably the main reason I think it's a good idea. And of course, if you're thinking that you want to pass on assets to your children, which is a goal of many people, I always say, you know, spend it for yourself first, but people still think they'd like to benefit their children. The insurance is a bulwark against that because you won't use up your assets as quickly.
I explored long-term care 2 or 3 years ago, and it seemed, maybe I'm mistaken, but it seemed like the amount of premiums that I'd be paying in limited the amount I'd be getting back to almost the same amount that I put in.
So Sam's question is, what about the expense of long-term care? Those of you who've explored it and haven't done it may have been scared off by the expense. And it's a legitimate concern, but my response to that is information is power. So sit down with an agent, ask them to show you various examples, ask them to show you a range of premiums, tell them what you can afford, and then look at it from there. You don't need the Cadillac of insurance because remember, you've got your own income, you've got some assets. So what you want to do is calculate, if I put all my own money to work, how much would it generate each month? Maybe that's $4,000 and you know the nursing home costs $7,000. So you then only need $3,000 or $100 a day of insurance. That's relatively affordable compared to $300 a day of insurance. And you know, the quotes you might get in the mail would say, well, you need this, and you know, you need this much per day, and you need it for the rest of your life. No, there are ways to limit the costs. You don't need a policy for the rest of your life because most people spend, on average, nationally, 2 to 4 years in a nursing home. So buy a 4-year policy, buy a 2-year policy, but have something there as a safety net that fits into your insurance picture. If you have life insurance, you may not need it anymore. Get rid of the life insurance, use that premium money for long-term care insurance. Of course, you do have to be insurable. If you have an illness, if you've been diagnosed with any kind of dementia, you're going to be screened out. Interestingly, back problems tend to screen people out, although I don't know why, but I guess there's a higher chance you'll go to a nursing home. But you know, you never know until you go and do the underwriting. And if they throw you out, then they throw you out. You can try another company. Companies vary, but I just think it's worth at least getting information about.
The normal insurance companies are famous for throwing people out for not having correctly reported all of their prior conditions, and they wait until someone is in the hospital to throw them out. Is that a problem also with long-term care insurance?
Less so, because they're totally focused on, in the initial underwriting, on what really is going on with you. So they'll have you sign all kinds of releases, and they will check all of your medical providers. And so that doesn't happen very much. I have had to fight with a couple of companies that once the policy was triggered, you know, they wanted to argue about the language in the policy and whether this person really met the criteria. That hasn't been true with the big companies. The industry has gone through a shakeout in the last 15 years. There were a whole bunch of players 10, 15 years ago. Now there are 3 or 4. There's MetLife, Prudential, Genworth. You know, there's just a few big players, and they pay well. They don't quibble too much about claims.
I just wanted to mention that more and more corporate benefit packages and therefore retirement plans and also professional association plans are offering long-term care insurance as a part of the benefit package. So people could look there as well.
Yes, Rosemary points out that there are group policies available through organizations and through employers. Speaking for benefit of the tape, I'm going to repeat all your questions. Okay, so your own resources, long-term care insurance, Medicaid and VA are 2 other major sources. The VA benefit is an interesting one. It's available to any veteran or spouse of a veteran or widow of a veteran if the veteran served during wartime. Didn't have to be on the front lines, didn't have to be wounded, just was in uniform during a time of war. And the VA sets forth all of these periods from going back to World War II, Korea, Vietnam, etc. So if there's a qualifying veteran in the picture, and that veteran or that veteran's spouse or widow needs long-term care, then VA will pay what's called aid and attendance special pension. And that is a cash benefit. It can be up to $1,900. Starts at $1,049 for a widow of a veteran and goes up from there depending on status, whether it's married or spouse or widow. You have to qualify financially as you do for Medicaid, but the qualification's a little different. For VA benefits, you can own a home, you can own a vehicle, and for a couple you can have about $80,000 in assets, or for a single individual about $50,000. But unlike Medicaid, you can give assets away without penalty under the VA system. So if you have too many assets and it looks like a good benefit that could work for you, then you can give assets away to a child or someone else and qualify usually right away for that benefit. It works best for those who are trying to stay at home or go to assisted living, because the amount of money that's paid is limited. Whereas with Medicaid, if you are going to Fraser Meadows, which costs $10,000 a month, Medicaid will pick up all of your costs over and above your own income. So you get a lot more benefit through Medicaid if you need that highest level of care. But we often say that Medicaid is biased toward the nursing home. That's where you get the biggest bang for your buck. But not everybody, of course, wants to go to the nursing home. And if they can stave that off by getting home care or going to assisted living, then this VA benefit can be useful for that. We have an excellent VA, what's called a VSO, Veteran Service Organization, in Boulder, a fellow named Michael Holliday, and he can help you for free through that process. I'm also a VA certified attorney, so I can advise about the benefits, but I can't do the actual application as I can with Medicaid. That's just a VA rule. But we've got a good guy locally who does it.
Rick, just for clarification, is this a one-time cash benefit?
No, monthly. I'm talking about monthly, yeah. So it's monthly income. All right, so I'm going to jump into Medicaid. I do have an outline if you want to follow along. And some of you, Vicki sent me some questions in advance. I'll try to cover all of that. But again, if there's something that you're wondering about, just shoot your hand up and we'll cover it, because there are lots of ins and outs to this program, and I want to make sure you understand it well. We've been doing this work for about 17 years. We probably talk to about 100 people a year. We do the applications, we do the planning to help them qualify, and also help them preserve some benefits, some of their own assets if they can, consistent with the rules that govern Medicaid. So Medicaid's a federal and state funded program. Half the money comes from the feds and half from the state of Colorado. The state gets to make its own rules, and every state is different. So that can get confusing if you move here from another state or you move to a different state. You really have to check what the local rules are. Medicaid's totally different from Medicare. It's an unfortunate name game there, but they're completely different programs. Medicare, of course you all know, is what pays for your health insurance. It really is just federal health insurance. And you're all entitled to it if you've earned into the system. Pays for your doctors, maybe your medicines, and hospitalization. But Medicare has a very, very limited long-term care benefit. You can only use Medicare's long-term care benefit if you've been in a hospital for 3 nights and then you're discharged to a nursing home for rehabilitation. Then you could use Medicare, and it will pay for a maximum of 90 days after that hospitalization. The first 20 days will be free. After that, there's a copay of $131 a day. So Medicare, like I said, it's a pretty limited long-term care benefit. And if you just, have declined with your health and there's no crisis, you don't go to the hospital, but you just check into the nursing home because you need to be there, there's no Medicare benefit at all. So from day one, you're on your own with private pay, or if you can qualify for Medicaid, then after 30 days, you can begin using Medicaid. So what's the eligibility? Yes, question.
Does the 30 days, does hospitalization count as part of the 30 days?
Yes, her question is for this 30-day elimination period for Medicaid eligibility, and I'm talking for nursing home. Now, does hospitalization count? Yes. So if you were 10 days in the hospital and then you went directly to the nursing home, the first 10 days in the hospital is part of the 30. But if you go home for even 1 day, it interrupts that and you have to start over.
For Medicaid?
Yes. Yeah.
Well, what if if you have the 30 days, do you have to continue, or can you go home then and then apply?
You can go home and apply for home-based care if you still meet the eligibility. But, whatever setting you're in, that's the benefit you're going to apply for. But the Medicaid benefit is the same. The application is the same, whether you're going to receive it at home or in a nursing home or an assisted living setting. Financial eligibility is the same, and they're going to evaluate you with the same criteria. So it really doesn't matter what setting you're in.
But 30 continuous days.
But if you want it in the nursing home, you need to have been there for 30 days. And that usually happens naturally because you would come from a hospital stay to the nursing home. Medicare Part A would pick up your initial stay at the nursing home. Then when you taper off that, if you have to stay longer, that's when Medicaid will kick in.
And then if you qualify for that, then if you go home, does that mean you can't apply for Medicaid?
If you've qualified and you're in the nursing home and then you go home, you can get Medicaid at home.
But not in a nursing home.
You could go back to the nursing home, again, if you meet that criteria. And I'm about to talk about the 3 criteria. So the 3 criteria for eligibility are what we call categorical. What are your needs? That's more the medical criteria. And then there are 2 financial criteria. But taking your question, let's talk about the categorical eligibility. So you have to need a certain level of care. And they evaluate that by sending out social workers who have a checklist, and they look at how you are performing your activities of daily living. And those are eating, bathing, dressing, mobility, transferring, toileting. I think I hit them all. And also, is there a need for supervision? That usually goes to some kind of dementia. So if there's a memory loss, a person could be able to do many of their activities of daily living independently. They can dress, they can eat, they can transfer. But they lose track of some things, like their medications could be a very important thing that they would need help with. So they could qualify under that criteria. So there's an evaluation of that level of need, and if you are looking to stay at home, then they'll just see, okay, what do you need help with those things at home? And Medicaid makes up then determines how much help you need. And they have contracting home health agencies, and they will send them in, they'll assign you a caseworker, and maybe you'll get a couple hours a day, maybe could be as little as a couple hours a week. It won't be full-time care at all at home. So you can't get 24/7 care, or even much more than about 4 hours a day. Though I have clients who do get that much. I had a fellow with MS who had the caregivers come in the morning for 2 hours, get him up, get him dressed, bathed, get some food. Then he had a fully operational, wonderful chair that he could get all over the house with, and his counters were low, and he really wanted to stay at home. So he could get through the day, and then they'd come in the evening for 2 hours, and they'd help him into bed. And he did that all the way through to his death. He never had to leave the home. And he was quite debilitated. So, he was determined to do that. He had help, and the Medicaid program was part of keeping him there. Question in the back? No? Okay. So that's the categorical requirement. If you need a nursing home level of care, people don't usually just check into the nursing home for fun. So I've never had anybody rejected categorically from a nursing home stay. I mean, when you're there, you have to be there. But the nursing home also has to fill out a form that says what your level of care is, what your needs are, and why you're there. And so the categorical requirement is quite an easy one to meet. The tougher ones to meet are the financial eligibility criteria. So now we're talking about the income requirement and the asset requirement. So income, an individual's income can't exceed $2,022 per month for them to be automatically eligible. But don't be fooled by that. You can have more income than that and still qualify for Medicaid. You can have up to $6,900 a month of income and still be eligible for Medicaid. But if you have more than $2,022, then you have to create a special trust called an income trust, where your income goes into this each month. Then you pay most of your income out for your care. You can keep $50 a month if you're in a nursing home. That's all you get to keep. The rest of your income pays to the facility first. Medicaid pays second. So Medicaid's always the payer of last resort. But income will generally not keep you out. That won't screen you out. That won't be an issue. It will be your assets that will be the tougher eligibility criteria. So an individual, and married couples and single individuals are treated very differently under the Medicaid program. I don't exactly know why. People ask me that. I'd have to look at the legislative history. There's a certain logic to it because the reason this came about was in 1988, what they call the spousal impoverishment rules were instituted. And prior to that time, a couple had to get rid of all their assets. And now the part of the couple who's not going to the nursing home, called the community spouse, can keep a lot more. So I'll talk more about that. But in any event, for single individuals, you have to spend down to $2,000 before you're eligible for Medicaid. You can keep your home of any value up to $500,000 of equity. It used to be a problem in Boulder. It's not as big a problem in the last 3 years because our values have gone down, but eventually they'll go back up. Currently, there isn't an inflation factor in that, but I'm trying to work on that, because if they just leave it at 500, eventually that's going to be pretty out of date. But that's the current number. One motor vehicle is exempt of any value. Medical equipment of any type is exempt. So my client's $20,000 wheelchair was an exempt asset. An irrevocable funeral and burial plan is exempt. Again, any value. So you get the gold-plated casket. Not too many people want to do that anymore. But, pre-planning does make some sense. You can pay for a cremation plan where they will pick up the body, do the cremation, deliver the ashes, and that can be very economical. But if you've paid for it now, you've taken that burden off your kids, you've spent the money, you've fixed the price, so you're done with that. Wedding and engagement rings, Medicaid doesn't make you sell your rings, so that's exempt. And life insurance with a face value of $1,500 or less. And it's hard to find a policy like that anymore, but there are a few. What I usually see with those are some veterans policies, or somebody's dad bought him a policy in the 1940s, and it only has $1,000 face value. But because I saw one of these the other day, the premiums were $0.25 a week, 25 cents a week, $1 a month, $12 a year. And, it's fully paid up, by the time the kid is an adult in the 1960s, and then just stays in place, but it builds cash value. So this particular policy had $4,500 of cash value because it was so old. But the face value is only $1,000. So Medicaid will exempt that. And, the person has a little extra there. So all other assets are countable. So this was one of the questions that Vicki submitted. And by all other, I'm talking, very, very comprehensively. So with a couple, we're talking about not only the institutionalized spouse, but the community spouse. All of the couple's assets are put into one basket, and Medicaid will analyze that accordingly. So they'll carve out the home as an exempt asset and the car, and then they'll look at everything else. And it could be if the spouse has a 401k and the institutionalized spouse has an IRA, and there are CDs, and there's a second home or a cabin up in the mountains, all of this goes into this basket. Then, again, for a single individual, have to get that all the way down to $2,000. For a couple, the rules are more generous. So the spouse who's not going in the nursing home or not receiving Medicaid can keep $110,000 of these countable assets. And it can be any of those assets that she wants to keep. So so the couple will have a choice. If she wants to keep it in the form of her IRA, she can do that, or cash, whatever it is. But the total can't exceed $110,000, except in rare circumstances. So that's called the Community Spouse Resource Allowance. Vicki?
That in addition, the community spouse would keep the house and one car.
Right. So the community spouse would keep the house, one car, and this allowance of up to $110,000, it's $109,560. It does go up every year, slightly, with inflation, and that's the amount that the community spouse gets to keep. Similarly, with the income, there are provisions for the community spouse so that she has something to live on at home. So let's take yes?
How is equity figured on a house? By the, what is assessed or what? How?
Question is, how is equity figured on the house? Good question. It's the regulations say fair market value, but in practice, Medicaid will accept the assessors. So I usually take my choice between the two. The assessors generally lag the market, but in the last few years they haven't been. So I've gotten some certified appraisals that have been lower than the assessors and used those. But fair market value is what the regulations say, and you do have to provide some proof. So usually I just use the assessor's latest.
Do they require appraisal then?
They don't require appraisal, no.
Can you give me the definition of community spouse?
Yes, so if we have a couple and one is applying for Medicaid, that is what we call the Medicaid spouse or the institutionalized spouse. They could also be getting Medicaid at home, so it wouldn't have to be in an institution. But the community spouse is the one who is staying in the community and not applying for benefits.
It has nothing to do with whether you're married or not.
Pardon me?
It has nothing to do with whether you're married or not.
It does, because if you're single and you're applying for Medicaid, then there's no community spouse. You know, there's only an institutionalized or Medicaid spouse. So it only applies in a couple's situation. Yes. So let me talk about the income with a couple. The income, unlike the assets, remember with the assets I said it's all in one basket. Income, it's the name on the check. Whose income is this? Is it the institutionalized spouse or the community spouse? And it's only the institutionalized spouse's income which has to be utilized for their care. And the community spouse will often get to keep some of the institutionalized spouse's income. So let's take an example of a husband and wife. He makes $3,000 a month from his retirement pension, and she has $1,000 from Social Security. So he's going to the nursing home. So when he applies, Medicaid will allow her to have $839 of his income to bring her up to what's called the community spouse, the minimum monthly maintenance needs allowance, the MIMNA, of all these acronyms. Anyway, she gets to keep some of his income so that she has enough to live on at home. And that number is currently $1,839. So if the community spouse's income is lower than that, and his income is sufficient, then they're going to bring some of his income over to her. And that amount can also be increased if she has excess expenses. It can be increased up to a maximum this year of $2,739. So what are some of those things that could bring that up? Well, if she has excess shelter expenses, for instance, she has a mortgage, $900 a month, and she has HOA dues of $200. That's $1,100. The amount that exceeds a certain base figure that Medicaid uses, which is $550. So in my example, another $600 of excess expenses. That will allow her to increase her income, her share of his income. So she could keep even more of his income up to a maximum of $2,700 just to meet her expenses at home. This isn't money that Medicaid's going to pay to the spouse, but it's money she gets to keep of the institutionalized spouse's income that otherwise he would have to pay to the facility. Is that clear? Okay.
And are there certain things that can be deducted as expenses?
Yes, there's certain countable expenses and certain things that are not, and they'll ask you that on the 27-page Medicaid application. It's a lot of fun. But they're mostly shelter-related expenses. So we're talking a mortgage, utilities, heat, light, phone. I don't think cable TV is in there. How could we live without it? Yeah, those kinds of
What
expenses.
about her health expenses?
If she has certain medical expenses, they might consider that. You can submit them, but generally they won't allow them. They have to be pretty extraordinary, and I've never really figured out what the criteria are because they won't say. It's sort of a, yeah, we feel sorry for you because you're paying $2,000 a month for your medicines. So it's kind of a case-by-case basis. Vicki?
Is there any difference or distinction between when the institutionalized spouse is going to a nursing home versus assisted living?
Is there a distinction between when the institutionalized spouse is going to assisted living or a nursing home? Not really in the eligibility criteria. All the things I've talked about obtain whether you're going to apply for either of those types of care. There is a difference if you're applying for care at home. That's where you'll see a difference, because the institutionalized spouse staying at home and getting Medicaid can keep their income up to the $2,022 a month level. So if they have that much income or more, they can keep that much of their income. That's because they're staying at home, and that's where they're getting their care. So they still, need to pay the lights and the heat and the food at home. So they allow them to keep their income. Just as if they're in an institutional setting, they have to use their income to pay the institution first before Medicaid will pay. So it seems a little counterintuitive, but that's the rule. They get to keep their income at home up to that maximum. If they have income above that, they have to pay for their care first with that excess income before Medicaid will pay for that care. So in home care cases, we have to analyze pretty carefully. How much are you making? How much will you get to keep? How much care do you need? And does it make sense to apply for Medicaid? It might make more sense if it's a veteran to apply for VA, or it might just make more sense to pay with your own dollars until your level of care rises to a higher level. Again, that's that kind of institutional bias of Medicaid, where you get more bang for your buck when you leave the home. I don't think that makes a lot of sense as a policy matter, but I don't make the policy, I just help people qualify.
If your income is together, everything's together, do they just divide it?
Well, if your income is together, she asks, do they just divide it? We're really talking about, there are very few examples of that, because we're not talking about generally investment income, though there could be. So I think the kinds of things you're talking about might be income from a joint account or a joint brokerage or something. But generally income is, who owns this asset, not the asset, but who is entitled to this income. So there's no such thing as joint Social Security income. There's no such thing as joint pensions. So usually we're talking about the fixed income that one spouse has and the other spouse has, not the investment income. Reason being that the investment income, by and large, goes away because you're divesting the income, the assets. You have to get rid of a lot of assets. However, it does come into play in the example where the spouse gets to keep $110,000 of the assets. Let's say she keeps all of that in a brokerage account, and that throws off $10,000 a year of income. That's countable income for her, and that will factor into how much of his income she gets to keep. Did I answer your question?
Well, like for example, we rent rooms. It's all together.
It's because you own
We own the house
a
together.
house, you rent rooms, so that's joint income. So it's a situation like that.
Do they just divide it?
If your spouse needed care, then what I would typically do would be to retitle the house to you. Then that income is your income. Because if we leave it as his income, it's more or less wasted, because he has to pay it first to the facility before Medicaid will pay. Whereas if it's all your income, you can use it, you can keep it, keep you healthy and pay for what you need at home. There's no penalty to him. You can have as much income as you want. It won't affect your spouse's Medicaid eligibility because it's the name on the check. So we make the name on the check be your name because now you own the house. Transfer that asset to you.
At the time of the need, or is there?
I wouldn't do it in
number of
advance.
Years before that you have to do
Oh,
that?
interspousal, good question. So as she asks about when would you make this change of title between spousal assets? And there's a big exception in Medicaid, and I'm going to talk about changing title and gifting in a minute. But interspousal transfers between husband and wife can be done at any time, and there's no penalty. So we generally wait until there is a need and an application, and then we do the interspousal transfers. Good question.
How is that impacted by domestic partnership relations?
So the question is, how are these rules about spouses impacted by domestic partnership? There is no such thing as domestic partnership in Medicaid law, unfortunately, not yet. And even spouses. So anyway, a domestic partnership, you'll just be treated like a single individual. And even spouses who have done a prenuptial agreement, that will be completely ignored by Medicaid. So it doesn't help you at all there. Might help you in another context, but it won't help you there. They'll ignore it, and they'll just apply the rules I'm talking about.
What if all your assets are in a trust, both of you?
Question, what if all your assets are in a trust? And many people do use revocable living trusts as a way of what we call a will substitute. This is your estate plan, I assume. You went to a lawyer, they said this is a way of avoiding probate, let's put your assets in these trusts. It's called a revocable living trust or a living trust. Doesn't help you from Medicaid standpoint. They view these assets as available to you because you control the trust. You're your own trustee, I assume. Correct? So, you're in control, therefore the assets are available to you just like the trust wasn't there because it's revocable.
But how is it divided?
How is it divided? Again, all the assets are put into one bucket, doesn't matter whose name is on them. Often we'll end up getting rid of a revocable living trust if we're doing Medicaid planning because one of the major exemptions, as I pointed out, is the house. But if you have your house in a revocable living trust, in Colorado, they say your house is not exempt anymore because it's in the trust. It's a very strange rule. I don't understand it, but that's the rule. So usually we either have to pull the house out of the trust or we might just blow up the trust entirely, revoke it, and go to a simple will kind of a plan. Which brings up another issue. In terms of estate planning with a Medicaid couple, you can do all this planning and get the spouse on Medicaid, and then what if the well spouse, the community spouse, dies first and they have a typical trust or will that says everything goes to my spouse at my death? Now spouse gets all these assets, loses their Medicaid until the assets are spent down. So we do have a trust that actually works for that, but it's an irrevocable trust, and we put it in the will or trust, and it only comes about at the death of the first spouse. If she happens to die first, then those assets would be placed into this, what's called a special needs trust, and it's exempt from a Medicaid standpoint. So the assets sit in that trust, they're available to the Medicaid spouse for their supplemental needs, but they don't disqualify the spouse. And at the second spouse's death, the assets can pass on to the children. So we have to change the estate plan too when we're doing this kind of planning. Vicki?
I'm really sorry. I hope these questions pertain to you all also. I'm sorry if I keep asking these questions. If a house is in a trust and then the couple doesn't want that, just split, it wants the house exempt, if the house then is transferred to the community spouse, is that considered an interspousal transfer with no problem?
Yes, it is.
So it can happen anytime?
Yes. Her question for the camera was, if the house is in a trust and is not considered exempt from Medicaid standpoint, can it be pulled out of the trust and given to one of the spouses? Yes, that won't be an interspousal transfer.
And then if the person dies, could you put it back into a trust?
And then if the Medicaid spouse dies, can you place it back in a trust? Yes, you can.
Can you explain a special needs trust again?
Can I explain a special needs trust? This is a kind of a trust, and one of the only trusts that will really work in a Medicaid context. We often use it for families with disabled children. but it can work in certain cases with elders. One is the one I just mentioned. But what it is Congress created this, and I think it was a senator who had a disabled child. It's a way of putting assets into a trust being just a vehicle to hold assets where you don't hold them in your own name anymore. You name a trustee, a person, a bank, or a professional to manage it, and then there's a beneficiary. So this kind of a trust, called a supplemental needs trust or a special needs trust, is specifically exempted by federal and state law. The assets in that will not be countable from a Medicaid standpoint. And there are certain restrictions on how you can use the assets. Not many, but a couple of major ones are you can't use them to pay for the beneficiary being a person getting Medicaid. You can't use those trust assets to pay for that person's direct housing costs, so their rent, mortgage, or utilities, and you can't use them to pay directly for food. So it truly is for their supplemental needs, of which there can be a wide variety. Any medical needs that are not paid for, we often use such a trust to pay for extra caregivers that might not be paid for otherwise, certain kinds of supplemental therapies that maybe aren't paid for by insurance. You can purchase things like computers, televisions, all kinds of things that could be useful to your loved one, but and those purchases won't disqualify them.
In the special needs trust, can the child, it happens to apply in our family, can the child have a special treat, like take a trip to see his grandparents or something? Is that?
Yes, entertainment, travel, all of those things. When they're traveling, you can't pay for their hotel with the trust funds, and you can't buy their meal. You can pay the hotel cost of their companion if it's medically necessary for that companion to go. So you have to administer them carefully, but it's...
But it would pay for the transportation if they had to fly there.
Correct. Pay for the plane tickets, the tickets to Disneyland, all of that. Yeah. So that's a special needs trust. So we talked about the resources. Let's talk a little bit in the time we have left about gifting under Medicaid, transfers of assets. And this is one of the ways that you can, well, let me jump back one step, following the outline, talking about spending down. That term refers to how do you get from, maybe you have $200,000 of excess assets, how do you get down to the $110,000 or the $2,000 level? One of the main things you can use is what's called conversion of assets. So you're taking countable assets and turning them into non-countable. How do you do that? Well, you might have a house that needs some repairs. Remember, the house is exempt. So if you put a new roof on, you redecorate the living room, you redo the kitchen, and you make the bathroom handicap accessible. And you spend $50,000. All of that you spent on an exempt asset. So you have taken countable assets and now sheltered them, if you will, in your house. Someday you'll probably get that money back out when you sell the house. You have to be careful that you haven't increased the equity of the house above the $500,000 level. But again, that's not as much of a problem now as it used to be. Another way of converting assets would be purchasing a car. If I'm planning for a couple, they have an old car, and again, the husband's going to the nursing home, wife can still drive, maybe they'll buy a nice, reliable four-wheel drive Toyota that's going to hold its value. $30,000 easily can be spent on that, get a 7-year warranty so she doesn't have to worry about repairs, and that's a way of sheltering some money there in something that she genuinely needs. Prepaid burial and funeral plans, we talked a little bit about that, another way of sheltering assets. Medical equipment. In my outline talks about the community spouse may be able to purchase an annuity. An annuity is a way of taking a chunk of money that would otherwise be a countable asset and turning it into a stream of income. So an annuity, if it's irrevocable, can be a way of taking a countable asset and just turning that into monthly income. So for instance, the community spouse might have an IRA with $50,000 in it. And if that plus her husband's assets put them over the limit, she could take her $50,000 and immediately annuitize that irrevocably. And if she's 70 years old, it's going to generate a couple $100s a month for the rest of her life. Now $50,000 is no longer on the table as an asset, and now they probably meet the asset limit, and he can qualify, and she's got a little more income. It does reduce her flexibility. There's some tax implications of cashing that annuity out. So all of these things have to be weighed. It can get pretty complex, as some of my clients can testify. We can work with financial planners, tax people, and analyze all the ins and outs of this. Transfers of assets, otherwise known as gifts. Gifting is not illegal under the Medicaid rules. You can give money away, but it does come with certain consequences. So you may have heard of what's called the 5-year look-back period. What that refers to is when you apply for Medicaid, they will ask you on the 27-page application, have you given anything away in the last 5 years, anything of value? And they're not talking about Christmas presents or a couple $100 to your daughter to pay a medical bill. They're really talking about gifts in excess of $1,000. But they want to know the cumulative amount of those types of gifts that you have made. And you might have made them rather innocently. You might have helped a grandchild pay for college. But you still have to disclose it. It's a federal crime not to disclose these things on the application. So I do have clients who say, well, they'll never know, will they? I say, well, I don't think you want to take that chance. Because I don't know what they know or who's watching who, but I do know that you don't want to violate federal law. We have a federal defender here. You could end up with Vicki defending you if you do that. But she's retired. Maybe she'd come out of retirement to help you. I don't know. But don't do it. You've got to be honest on these applications. So let's say that even innocently you did transfer assets in the last 5 years. You have to disclose that on the application. And Medicaid presumes that you made that transfer for the purposes of qualifying for Medicaid, which is an interesting presumption. You can rebut the presumption. You can bring in evidence to overcome that, but it's extremely difficult. The example I gave of helping the child, you might think that's an easy one. I was just helping my grandchild. Yes, but maybe you also thought, this will help me, get my assets down. So there could be two motivations there, and you really have to prove that that motivation was not even in your mind. And how do you do that? That's kind of tough. The fact that you're attending this today, I'm afraid that goes against you, because now you have the knowledge to...
But ignorance is no excuse.
That's right.
Rick, you said that was 5 years. A few years back, was it 3 years?
2 years back, it was a 3-year look back.
Okay,
It changed in 2006. Yes. So when there was a 3-year look back, we used to do a little more gifting than we do now, because if you had a little bit of lead time, let's say you had someone with an early Alzheimer's diagnosis, they could give away a substantial part of their excess assets, maybe to their children, with a clear understanding, child, you're going to hold this for me, but you can't put strings on that. That just has to be an understanding between you and the person you gift it to. Because if you write it out that you're going to hold this for me, well, that's a trust. And then Medicaid says that's still available to you, the parent. So it has to be a gift that you give away with no strings. But if you had 3 years, you could give it away and keep enough back to know that you could, even if the wheels came off and you had to go to the nursing home, you could get through those 3 years. It's a little tougher to get through 5 years. If you have a policy of long-term care insurance, though, that can help you get through the 5 years. And I do have clients who will, if they have that and they have pretty good income and enough assets to tide them through if the worst happened, they might make a substantial gift, knowing that by doing that, at the end of 5 years, that spouse, or maybe even both of them, would be eligible for Medicaid. I have a couple who, both the husband and wife, are in care now. It's costing them $18,000 a month, and they had about $900,000 of assets. So we did one of these 5-year gifts. We gave a substantial amount of it away to their children, who have an agreement among themselves that they won't spend it. It's not an agreement between them and the parents, but among the 3 siblings, no one of them can spend it without the others. So hopefully that's at least puts the brakes on one of them going off to Vegas and gambling the money away. But anyway, we looked at it carefully, we analyzed it, we said, okay, at the end of 5 years, they have enough to get through the 5 years. At the end of the 5 years, they'll both be eligible for Medicaid, and they will have preserved about half of the money for their kids and for themselves, frankly, because again, on Medicaid you only get $50 a month for your personal needs. Well, the girls are holding on to this other money. If the parents need anything, they can supplement with that money. Question?
In the event you qualify for Medicaid, do you have any limitation on what facility you go to?
Good question. If you qualify for Medicaid, you have a limitation on the facility you go to. If you're going to a nursing home, almost no limits, because most of the nursing homes, I'd say 95% of them, accept Medicaid. The only one in Boulder County that does not is Balfour. It's a very good facility, it's family run, and they just made that decision not to do it. But places like Fraser Meadows, I mentioned, accepts it, and it's an excellent facility, but they do accept Medicaid. And almost every other nursing home in town. Now, assisted living is different. Probably only 30 or 40% of the assisted living facilities accept Medicaid. And that's, again, just a business choice they get to make. So you have to look pretty carefully for one that would accept it. The quality of your care is not going to suffer whether you're getting Medicaid or paying privately. It's illegal under federal law to discriminate based on the source of payment. And they don't, at least in this state, they don't. I've heard some stories of other states where you really do get subpar care in the Medicaid facilities. It's not the case here. Good question.
Will you just tell what Medicaid does actually cover?
So what does Medicaid cover? In the nursing home, it covers everything. It covers all of the rent, all the food. Let's talk about what it might not cover. Might not cover certain incontinence supplies, though I think they do cover that. They're pretty comprehensive with what they cover in the nursing home.
I think not a haircut.
Not a haircut. That's right. That's what you need your $50. Yeah. And
But all medicine?
yes, so they're going to work together with your Medicare. Medicare is the payer first, but if there are co-pays, which there are with Medicare, even with Part D on the medicines, Medicaid's going to pick up all of that co-pay. So you end up paying nothing. And typically you can drop your Medicare supplemental insurance once you go on Medicaid, because Medicaid becomes the supplemental.
Could we go back to the gifting for a moment? Supposing you've been giving, I don't know, $100 a month to a grandchild for their college. And then 10 years later, you need to go on the Medicaid support. Do they go back for the last 5 years and say, well, that money was gifted and is not included in your exemption?
Question is, what if you're making $100 a month gifts to help a grandchild with college? Can Medicaid pick that up and penalize it? The answer is technically they could, but typically they won't. They just won't bother with gifts, even if they're serial gifts like that, because they just are small enough that they don't rise to the level of concern.
Would there be a difference between this $100 a month versus you made 1 lump payment of $1,200? Would that be a year? Would that be scrutinized differently?
I think it would, yeah. Would there be a difference if it was one payment a year of $1,200? I mean, they'll look at your checking statements and your bank statements back 6 months, and they'll pick out any large expenditures. I want you to explain those, in addition to just asking about transfers.
When you apply for Medicaid, and it's always, they will accept this or they won't. Is there a local office in each state that evaluates each application and on a timely manner?
Timely is an interesting word. And the question is there a local office that administers the applications?
How does this work? The government?
Yes.
It's a government program.
It's a government program, and the funds come from the feds and the state, and interestingly, it's the county that administers it. It's the County Department of Social Services.
So that would be Boulder County.
Boulder County Social Services up at Broadway and Iris. They also do food stamps, and they do welfare, whatever that's called now, TANF. So that's the department. Are they timely? No, they're terrible. They're very, very slow. And they're under federal scrutiny for that. There's been several federal audits. CMS, which is the federal agency that oversees Medicare and Medicaid, is threatening to sanction the state for this, but it goes on. And it's really a battle. And we deal with it every day. We know all the technicians. We try to, be nice to them and yet push them along, but it's difficult. But the good news is, if you submit your application and it's been well prepared and you're spent down and you're eligible on the date you submit, and they don't process it for 9 months, which happens regularly in Jeffco. Boulder County is usually about 3, but they have to go back to the date of eligibility. And then, they'll pay it's usually a nursing home has to sit and wait for their money. Your obligation while you're waiting for the decision is to pay just the patient portion, which would be your income, into the facility. But you wouldn't have to pay all the costs. And then Medicaid will reimburse the facility later. And the facilities hate it too. I mean,
They're getting their money.
there's really no reason it should be that inefficient, but it is. Travis?
You've discussed the case of a special needs child. If you have an adult special needs child and they qualify for Medicaid, then what is the benefit? What do they realize?
Sure. The question is, for an adult disabled child, what kind of benefits can they get through the Medicaid program? It could be a variety of things. Certainly their medical expenses, all of their co-pays, their medicines. If there's a mental impairment, oftentimes they could become, sorry, that's my son calling. Quiet. There we go. They could become a client of Boulder Mental Health. It's a portal for eligibility for SSI and Medicaid is a way into other kinds of benefits. Housing benefit. A disabled adult child could use the local agency, here it's Imagine, to get on the waiting list for sheltered living. And it's a long waiting list, but if they got it, then they assign their SSI and their Medicaid to that agency, and they get complete services. They get housing, they get food, they get case management, they get their medicines, everything under one roof. And there's a variety of other types of benefits, but adult disabled children can get a number of benefits by being eligible.
I have a question about the special needs trust. Until or unless a beneficiary of such a trust needs or applies for Medicaid, which isn't anticipated, but if it's not doing that, can some of that money be spent for food and shelter that's not provided by other benefits?
Sure. Good question. For a special needs trust, Can the money be spent for food and shelter if the individual is not getting SSI or Medicaid or benefits that would be affected or impacted? The answer is yes. So at least if it's a properly drawn trust, and I always put that flexibility in my trusts so that the trustee has that flexibility. And even if the person's on benefits, the trustee still has the flexibility, because it might be in that beneficiary's interest to reduce the SSI by paying some housing costs. Because there's a dollar for dollar reduction if you're using the trust funds to pay for things that SSI should be paying for. It'll reduce the beneficiary's $674 a month income, but that could still be in their best interest. So you want to draft flexibility into those trusts that allow that.
At the end of the material I read, they talked about liens. That scared me.
So that's my last topic. Let me just get that in quickly. Estate recovery is a program under Medicaid whereby at the death of the Medicaid recipient, Medicaid can come knocking at the door and say, do you have any assets left? We'd like some back. And they will do this if there are any assets. But remember, the Medicaid applicant had to spend down to $2,000. So typically they won't have any. But where this can come about is a single individual who didn't have a spouse that they could transfer the house to, so they kept the house in their own name. And then they died owning their house. The house was exempt while they applied. Medicaid didn't do anything about it, but they waited until the person died, and then Medicaid has up to a year to make a claim in the probate estate of that individual for repayment.
For total repayment?
Total repayment of everything they've been paid, yes. But they can only get that much. So if they only have a claim for $100,000 and the house is worth $400,000, then $300,000 can go to the heirs. Medicaid has to be paid first. They have to make that claim within the first year. In a couple of cases I've had, they've not made it within the first year. They just, again, inefficiency can sometimes go to your benefit. You can't count on that, though. They've gotten a little better with it. They farmed it out to a private agency that does a little better job. There are some ways to avoid estate recovery, again, if you have time. One of the big exceptions that I'll mention, because it does come up, is if, let's say you have a single parent and they're living at home, they want to stay at home, but they really do need a higher level of care. Their daughter moves in and starts giving care. And if that care is provided for a period of 2 years continuously, and the daughter's in the home, and a physician can certify that absent that care, mom would have had to go to an institution, then mom's allowed to transfer that house to the child with no penalty. So that's a big benefit that a lot of people don't know about. It can be very useful.
My question is, how much range do you charge to figure out either a couple or an individual's best plan for all this?
What do we charge to figure all this out?
Because this is a lot.
There's a lot. So people come to our office for an initial consultation. We tell them everything to bring, and it's all your financial information. We'll sit for usually an hour and a half or two. We'll find out a lot about your medical situation. We have social workers who actually work in our office. We're the only elder law firm in the state that does that. So they're trained in geriatric care, and they analyze what the care needs are, and that helps me do the planning that I need to do on the financial side. So in that first meeting, which we charge $400 for, we're just getting an overview. You're getting to know us, we to know you, and we see, are there some planning opportunities? If there are, then we will quote a fee based on what you and we think this is going to need. And it can range up to $9,800, which will include all the services of our social worker, helping you find a facility or stay at home, helping me do all the Medicaid planning and the asset preservation. So that's sort of the Cadillac, right around $10,000. But if you don't need all those services, then we have other ranges in there. It's a flat fee. Once you pay it, then you get unlimited use of our time and our social workers' time as well. And most of my clients say that's where they get the real benefit, because Sandy Tobin, who does that work for us, lots of experience in the facilities. She really knows how to advocate. She'll go to the care meetings. She'll get in the middle if there's an inappropriate discharge and argue for keeping the client there.
It's an ongoing thing.
Yeah, so it becomes an ongoing
Yes.
benefit. Yep.
Thank
We
you.
call that life care planning, which is a little brochure about that in there. And that initial $400 that you paid is applied to your later fees. So if you do further work, then you get credit for what you paid. If you didn't, you just got some information and you paid $400. And I have to run because my mom's in town. She's 94. And
You got a plan in place.
yeah, I have a plan in place. On the way from the airport to home, we stopped at my office and we did Colorado Powers of Attorney because she's going to stay here. And so we got all that in place. She's actually moving to Fraser Meadows.
You'll like it.
Yeah, it's a great place. Yeah. And so I get to now be, on the inside and see really how it works. So thank you all very much. And
Thank you.